All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to go over a very important concept in today's video and explain this chart, right? It may look like just a bunch of scribbles, but it's actually something very simple and also very important to pay attention to. We've got the S&P 500 on top, and we've got credit spreads on the bottom. Now, you may be asking yourself, what are credit spreads, right? And why do they matter? Why are they important? So we'll break that down in today's video, give you guys the definition of credit spreads, how investors and traders can use it, and really just define all of these things for you, and then go over my favorite way to use them, okay? And one of my favorite ways to use them is to spot divergences, right? So we'll also explain these divergences, go over that, and really just make things very clear on, what form of credit spreads that we're looking at in this video, why credit spreads are used in the first place, and how you can use these positive or negative divergences to potentially see or rather as a leading indicator for future price action in the stock market. So it's going to be a really great informative video. You're going to want to smash the like button and subscribe to the channel because I drop content like this all the time. As always, though, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. We'll go ahead and get going. But before we do, I do want to mention that I started a completely free newsletter for you all called Investment Intelligence, giving out free valuable finance content and free trade ideas. Every single week, I try to sprinkle in 1 to 2 free trade ideas, and we'll highlight the chart conditions right here, go over and show you the chart itself, and many of these trade ideas have worked out very, very well. Let's take a look at the last 3 that I've published. We have Teladoc had ran up over 14% since the time that the newsletter came out. We have PayPal ran up over 10% since the time that the newsletter came out, and Rivian ran up an astonishing 40% since the time that the trade idea in the newsletter came out. So it's more of a concept of quality over quantity. So I'm not spamming your inbox every single day with 5 to 10 different emails and trade ideas, bragging about 1 or 2 that worked. Rather, it's looking for high quality setups, finding those high quality setups, and then sharing them with y'all completely for free. So if you enjoy content like that, sign up for the newsletter using the link in the description below. You can also just directly join the Investment Intelligence Discord. It's only $10 a month, and that's where you get access to all of the different trade ideas, right? So you can see PayPal's in here, you see Teladoc's in here. Okay, Rivian went up over hundreds of percent as well, but that's also where we had other trades in here, such as Palantir, Chewy, Carnival Cruise Lines. SoFi was a really, really huge play. All right. And you get complete access to everything, as well as the custom scripts and indicators. And even the chart that I'm showing you in this video is actually shareable via Thinkorswim's flexible grids. And I've got over 35 chart layouts for everyone in the Discord, measuring market breadth, different instruments of risk on versus risk off, as well as credit spreads. Now let's get into it. And up top, we mentioned we've got the S&P 500, and on the bottom, we've got a ratio chart of the HYG and the IEI. So this is basically a form of credit spreads. Okay, and there's many divergences highlighted. So, you see when the green arrow is going up and then the red arrow is going down, this is a point where there's a divergence between the S&P 500 and the credit spread ratio here. Now we're going to break down all of that more in today's video, but let's go ahead and define what a credit spread is. So it's the difference in yield between 2 bonds of similar maturity, but different credit quality. Credit spreads reflect the extra yield that investors demand for taking on the additional risk of a bond with a lower credit rating compared to a risk-free or a less risky bond. Wider credit spreads indicate that there's a higher perceived risk of default on the lower rated bonds, while narrower spreads suggest lower perceived risk. Credit spreads are a critical indicator in financial markets because they provide insights into the overall health of the economy and the risk sentiment among investors. So wider spreads, typically during economic downturns or periods of market stress, investors demand higher yields for taking on the risk of default, leading to wider credit spreads. This can signal increasing pessimism or risk aversion in the market. Now, narrower spreads. So in contrast, during times of economic growth or market optimism, credit spreads tend to narrow as investors are more willing to take on risk for lower yields, indicating a risk on sentiment. So investors and traders use this credit spread information to gauge the risk environment, potentially adjust their portfolios accordingly. They can also identify arbitrage opportunities between different bond classes, make informed decisions on the relative value of bonds and other fixed income securities, speculate on changes in the economic cycle, and use it as a leading indicator for other markets, including stocks, right? So that's why credit spreads are important. Now, they are not a measure of market breadth. So I've already started my market breadth series. It's a really good series that you guys are going to want to check out, going over things like the McClellan Oscillator, the McClellan Summation Index, and many other things are coming in addition to that market breadth series that I've got for you guys. But market breadth itself refers to the extent to which movements in a market index are broadly reflected across the individual securities that compose the index. Now, it typically involves metrics that compare the number of advancing stocks to declining stocks, new highs to new lows, or volume flowing into up stocks versus down stocks within an equity market. Market breadth is used to gauge the overall health of the stock market and to identify whether a market move is widely supported by individual stocks. Now, credit spreads, on the other hand, are an indicator of the perceived risk in the credit market. They measure the difference in yield between two bonds of similar maturity but different credit quality, right? And this is kind of what we talked about before, but basically this is going to be between something like, let's say, corporate bonds and government bonds. So credit spreads reflect the additional yield that investors demand for bearing credit risk associated with lending to corporate borrowers as opposed to risk-free government borrowers. Now, credit spreads are best described as a risk sentiment indicator or a measurement of credit risk premium. They can be used to assess investor confidence in the economic outlook. Okay. And we kind of already talked about what wider spreads mean and what narrower spreads mean. So now that we have a general, understanding of what credit spreads are, okay, and what they can be used for, okay, now we can come over here and we can take a look at our credit spreads chart right here. And we can see when the SPX is going up, but we're seeing credit spreads go down right here. Remember, this is more of a sign that there's a little bit of worry about the economy, or potentially that the market is actually more risk off, okay, than it is risk on. So up here, we can see that this is actually a point where now we have this negative divergence in our credit spread measurement here. And this indicates that, hey, maybe the market is rallying, but underneath the hood, the market is actually becoming less risk on and shifting more towards risk off. And it's possible we could see a pullback in the market, right? And sure enough, we end up getting that pullback. Same thing over here. We're seeing, higher highs in the S&P 500. We're seeing lower highs in our credit spread instrument, indicating that, hey, the market may be due for a pullback, right? And sure enough, we pull back. Here, we're seeing the exact opposite. We're seeing a low and a lower low in the stock market, but now we're actually seeing a low and a higher low in our credit spread measurement here via the HYG and the IEI. And that's an indicator that, hey, maybe the stock market is due to potentially rally. So, that's a quick overview of how I really like to use this chart and, look for valuable data in the markets. Now, a ratio chart of HYG to IEI represents the price performance of high yield corporate bonds, okay, which is represented by the HYG, relative to U.S. government bonds as represented by the IEI, which tracks an index of U.S. Treasury bonds with maturities between 3 and 7 years. So in this case, we're looking at the high yield corporate bonds versus the US, 3 to 7 year bond ETF. Now, in this type of chart, a rising ratio indicates that high yield bonds are performing better relative to government bonds. This can be interpreted as a sign of risk on sentiment in the market, where investors are more willing to take on risk for potentially higher returns. And so if we take a look over here more recently, okay, we can see, we have a high, we have a higher high, and we have a higher high, and here we have a high and we have a higher high. Now, this was actually a really good indicator, recently, okay, where we were making higher highs in our credit spread measurement here, but making lower highs in the stock market, that, hey, maybe this pullback isn't necessarily justified, and maybe underneath the hood of the market, things are actually a little bit more risk on than they seem. And we saw a very strong push up afterwards, basically a very quick correction. So you see we had a slow grind down, and then we just saw a massive move to the upside afterwards. And right now, what we're seeing is confluence, where we're seeing a rising ratio here, and we're also seeing a rising S&P 500. Now, a falling ratio suggests that high yield bonds are underperforming compared to government bonds. This can be viewed as a risk-off sentiment, where investors are seeking safety over higher returns, and those are areas where you may potentially start to see some pullbacks. Right here, we have a higher high, lower high, lower high, higher high, lower high, lower high. So we're seeing these things move in accordance with each other, right? And typically, that's what you're going to see, except in these periods of divergence. So investors and traders pay attention to this chart because it can serve as a gauge for the market's risk appetite. High yield bonds are riskier and tend to have a higher correlation with stocks than government bonds. Therefore, when the ratio rises, it might imply that investors are more confident in taking on risk, which could be bullish for stocks. Now, conversely, when the ratio falls, it implies increasing risk aversion, which could be bearish for stocks. Now, divergences between the HYG IEI ratio and the SPX could potentially act as leading indicators for future movements of the SPX or the HYG IEI ratio chart. So the positive divergence, we talked about this when if the S&P 500 is declining while the ratio is rising or stabilizing, this could indicate underlying strength in the market that is not yet reflected in the stock prices. This might suggest that the stock market could rebound in the future. Then you also have those negative divergences where if the SPX is rising while the ratio is declining, this could signal underlying weakness in the market, and it might suggest that the rally in stocks is not supported by a risk-on sentiment and could be vulnerable to a reversal. Now that wraps up today's video. And if you enjoyed today's video and you'd ever like to book a coaching session or a one-on-one personal session with me, head on over to my Ko-Fi page using the link in the description. Click on the commissions there, and that's where you can book a 30-minute or a 1-hour session directly, right? I do those all the time. You can also request a YouTube video on the topic of your choice there. And you can also click on this buy a coffee button, basically a way to leave a tip or donation for the free valuable content that I do put out, such as the newsletter, Investment Intelligence, giving out free trade ideas and free valuable finance content. Okay, you're going to want to sign up for that if you enjoy, free trade ideas and valuable content, or you can just sign up for the Discord directly.